Dr. Bruce Sherrick, thank you so much for joining us on Land and Everything Else podcast today. I've been looking forward to talking with you since we had the idea of the podcast last fall, so I'm pretty excited we get a chance.
It's great to be here.
I'm sure we'll have you on multiple times. So this is our first one with you. I guess first thing, I know you have a lot of hats, but if you could sort of introduce yourself to our listeners.
I am a veritable hat store right now. I'm a professor at the University of Illinois, and I work a lot also in a consulting company on crop insurance events, private product rating, and some rating for RMA's products. Also have some land investments around the country and do some things with folks to help structure finance better for farmers and for institutions serving farmers.
And I think that's what makes me very excited to talk with you today. A lot of what we're trying to do on Land and Everything Else is bridge a meaningful gap. And that gap is we've got the wealth management, the financial service community, we've got investment advisors, broker-dealer reps, we've got insurance agents, right? And we've got customers that maybe the advisor's interested in alts, the customer's interested in alts, and how do we move that portfolio beyond stocks and bonds? So that's the market that we're looking at talking to today, and we're so excited to have y'all tuning in. But first up, Bruce, you've invited us so cordially and with such hospitality to the Land Expo, where we've been shooting a lot of episodes. Why don't you tell us a little bit, what is the Land Expo?
The Land Expo has just grown into one of the must-go-to land investment conferences annually. Steve Brewer at People's Company started it 17 years ago, I believe, and partly as a mechanism to connect with customers, but it's grown to become an industry-wide event. Anybody who lends to agriculture, invests in agriculture, lends to people who work in agriculture, service companies, but anybody who has exposure to what's now becoming a real investable asset, farmland, crossed a $4 trillion asset value mark this year. And so it's become kind of that place where everybody can come to one location and share that information or get insights about the asset class.
Well, and it has really been a fun event. And I would encourage any wealth managers listening in, particularly those in the Midwest, check it out next year. I think there's been a lot of value, and I think I would have gotten value from that perspective. But I want to start our conversation today a little meta, step away. But, we talk a lot about alts and farmland alts and ag alts, from that end, and investments. When you think about consumer portfolios, retirement portfolios, you think about financial legacy and passing wealth. Where do you see alts, specifically farmland ag alts, in that picture?
I would break it into two categories. First, if you think about the financial performance of the asset class, historically and very reliably historically positively correlated with inflation. So as a wealth preservation, if you don't have to consume the annual income from it, it's done very well. On a lifetime basis, tends to beat the S&P 500, in fact. Difficult asset to buy and sell, so that's not necessarily the end of the conversation. Sure. But very high correlation with inflation, very long duration, and a mixture between income and appreciation that's been pretty reliable through time. So it becomes an attractive asset for somebody like a pension fund. This is the one class of investment that I've said I'd break it into two. A pension fund really would find this to be an attractive asset, and that's a large number of the NACREIF investors, National Council of Real Estate Investment Fiduciaries, are in that space. And it's done very well, generally. Individual properties, like any other asset, when you're that specific, have different annual returns, but it's been a great asset in that case. But your question was really for an individual. For an individual, those same return characteristics still matter. Fairly high return. Fairly low cash return, though, and a lot of it in appreciation. But as an asset, there's some tax advantages, generally a step up in basis at death if you're going to hold the asset through death, very tax efficient in that regard. And some other things, if it's part of an operation, are also very tax efficient.
We were talking a little bit in the hallway a minute ago about, land being able to be this pretty amazing legacy asset as it does roll through generations. I wonder if you could expound on that a little bit.
Sure. For a farm family, there are some constraints. You can't really just buy land everywhere around the country in 3-acre parcels or something. It has to be one of meaningful size, and contiguity or distance or approachability from a base of operation is really critical. But that asset then can be transferred to the next generation, generally in an incredibly tax efficient way, not just to avoid estate taxes if you are, if you're under the federal estate limit, that's one thing, but you also can structure in family transmission mechanisms, family corporations and other things, or other advantaged ways to transfer it down to the family. I know I'm kind of stumbling through the explanation, but it's because it's so flexible that the specific characteristics of your operation probably dictate the version of that.
Sure.
If you have 3 kids or 1 kid, if you have an uncle who still has partial ownership, if you inherited it from 3 generations, great-grandfather, those circumstances will dictate the different way you would accomplish that final step. But I think almost all farm families have discovered that it's a really useful asset for legacy wealth building.
So I'm going to transition a little bit to your Illinois hat, so we can both put our Illinois hats on for just a minute. In your time at the U of I, you've probably taught hundreds, if not 1,000, future wealth manager, financial planning students, right? And in investments and other areas too. What is it about having an ag element in an investments class that a student goes into this market with that maybe distinguishes them from a student that took a wealth management and maybe a corporate finance path? Like, where would you say, okay, we've intentionally included this in the curriculum and we've done it for years. Why include it, right? And then where do you see that down the road helping that student?
Sure. The question has, because of what we both do, we know a little bit more about the background, but I'll just say out loud, the first Farm Credit institution was essentially started by a faculty member in our department in the 1920s, about 1920s. And from then on, this idea of managing a financial perspective from a family base rather than from a dollar is a dollar is a dollar base.
Sure.
Became kind of that decision-making centrism for looking at farm finance. Also, the agricultural financial banking system is organized outside commercial banking. It's a separate section of the Code of Federal Register. So that sort of history led to why it's in our department. But then why did we do it in our department?
Right.
It's a very heavily concentrated asset when you own it. In terms of your balance sheet, you're going to have a lot of your wealth invested in that single asset. And that creates a little bit more complicated portfolio solution problem, perhaps. And it's not easily divisible, and you can't sort of rebalance in the same way. But the fact that it's a real asset, much like a house would be, but also an income-producing asset, means that it does get some special treatment. I think the other fun thing about agriculture is it's one of those annual long production cycle. Income is only once a year at most, unlike a publicly traded company that has quarterly returns. Lots of other things that have led to that sort of plinko of circumstances that the CFP is in our department. But we're also really good about working with individual customers, I guess. And that's a feature that I think at least our department through time has maintained that legacy.
And I think it's sort of an interesting perspective coming in on that. One of the things I kind of have the reverse experience, right? Is that my career started as we didn't call it wealth advisor then, right? We called it financial planner, but started as a financial planner. And so I had opportunities working with medical practices, right? They'd be C Corps or they'd be S Corps, they'd be, medical corps or whatever you want to move with that. And I had a lot of experience with that, right? The corporate side of it and planning and legacy and partnership and sale and valuation and all these things from that end. And so when I walk in the door at Illinois and there's these conversations about, we're going to do, legacy and estate planning, and we're going to do it for farmers. I was like, well, that is shockingly similar to how we would do it for a dentist. Now, there are, of course, some differences there. But one of the kind of takeaways I got is I think one of the cool things about how we teach a student about investments or legacy or estate, when you have this farm asset, they're learning how to work with a business. And they're learning usually how to work with a small business and a non-publicly traded business, right? And so it's really cool to see someone come out the door and they understand, okay, well, I have some concept of this idea of an LLC and some concept of personal property and real property. And I have all these sort of pieces together. And maybe it's agriculture, or maybe it's real estate, or maybe it's medicine, or maybe it's something else entirely. But they have sort of an underlying working of the operation.
Right. Yeah.
And I think that is just incredibly valuable that we teach that. So
it's a great point. The fact that it is a business first, and as a business first, many of the same principles still apply.
Yeah.
But as a family business, it often has a few additional features that you might not get if you were running the local hardware store or something. And so I think those other differences are really important and mean that you have to teach it in almost a specialized curriculum.
But you do, and I think it comes out so much better for it, right? Having those pieces. And, I've gone back and forth in my world about it all, right? But I think I've come to this idea that, students that have a good understanding of a sector outside of just traditional education, tend to do a little better. And,
Indeed.
And I really like that. So that was just kind of a aside, but I did want to talk about it
fun,
today.
Yeah.
It's a fun, we can take off our teacher hats now, but I think that was a fun conversation. To the other end, I'd like to sort of get into two really important questions, but I don't just want to answer them on the surface. I want to dig a little with these. All right. The first is the case question that I like to ask people. And the case question has two pieces, right? First up, you've got a consumer, maybe a retired junior executive manager. This person's got $1 million. They've got it in an IRA. Maybe they've got some non-qualified money, and they say, okay, I've got some money in stocks. I've got some money in bonds. I want to put some money and I want to buy into some alternative asset classes. And I've got, let's say, somewhere between $10,000 and $100,000 to do that with. Where does the mind go? Where does your mind go in that situation?
So my mind first defaults to what I was trained to do, which is to think about everything like a portfolio problem. And first, does that asset actually work well with the other things you own? And historically, what we find is, and it'll sound like a broken record here, but low beta, high alpha, and correlation with inflation. So generally, if you just naively solve the optimal portfolio problem, you almost always find that you should add real assets. And agriculture, as one of those possibilities, is a really important one and performs well. But then it's really hard to do. Farmland is a very thinly traded asset. Only 1.5% or so turns over per year. So you can't just go, oh, buy the farms around me this year.
Right.
Secondly, it's very chunky. It's hard to buy a small farm, and it's not going to generate the returns to agriculture transmitted to you if you aren't at scale anyhow. So you essentially have to look for some version of a commingled investment if you're that small. If you're not at the point of saying, I'm going to have an actual operational farm scale investment, you're looking at something that might requires some commingled funds. So a couple of the things that have popped up in the last few years, fractional investment platforms have begun to pop up, and they have, to be honest, mixed experience so far, but they're a way of beginning to experience the asset class. There are 2 publicly traded REITs that invest solely in farmland, but they're highly specialized. NACREIF is, as I described, comprised primarily of pension management funds, and so you could designate part of your 401 or 403 into one of the particular funds if you happen to be with a family that has an agricultural fund. But I think in each case, it's a specific asset. So it's not the same as looking through the ticker symbols and choosing something or selecting a mutual fund based on
not quite as easy as the Morningstar screen.
No, not at all. And so finding that qualified advisor who does know something about agriculture and can begin to put those vehicles together.
Well, no, let's change the conversation then. All right. Instead of $1 million, well, I've got 40 or 50 million. Okay. So now we're in a position where we're looking probably at private equity. We're probably looking at some private credit. We're definitely, yes, we do have some publicly, equity and debt in that portfolio, but now we've hit 50 million, right? We've sold a business. There is an investment to be made in the alternative space. If it's going to be in the ag space, now where does the mind go? And I kind of want you to answer this from the perspective of, if I walked in your office at U of I and I was, maybe on the Dean's Council and I just had this $50 million payday, who do I need on that team?
So the folks, I can tell you all 50 of them are here today at the expo. And so there are entities that will do the privately managed, bespoke, deployed capital with a particular investment thesis. So I want exposure to permanent crops in Southern California because I have some other set of holdings, or I want primarily timber, or I want diversified row crop agriculture. So once you get past the investment thesis, then finding the company that can do those fully managed, generally, investment platforms, again, they're in the room today. This is part of the purpose of the expo.
Right. Which I think, just to call out again, if you have significant client wealth and you're thinking about alts, this is a place to visit
yes,
and go.
Yes, it is. Yeah.
One kind of follow up on that, you just said investment thesis, right? And when we look at within alts, within agriculture, is it an income play or an appreciation play?
Right.
What would you consider maybe 3 or 4 kind of basic strategies within ag that someone may pursue?
So row crop is the simplest.
Okay.
And annual income, cash rent situation. So I buy the asset, I rent it to you. You pay me annually, but I keep the appreciation. Not quite the same as thinking through something like a triple net, but not that far off.
Okay.
It's basically I have an asset and you're renting it from me, but I'm keeping the exposure to appreciation. Or I might have something that has permanent crops, so apples or wine grapes, or something where part of the asset is above ground, doesn't go away year to year. And I might share in the operating company return to some activity that's with that in mind. Or I might have a particular thesis where I need a carbon offset and I need a set of practices that have a particular environmental play associated with them. All of those are in play when you get to agriculture. And I think you kind of nailed it when you asked the question about kind of intimating that it's hard to first select what your investment thesis is or what you need from them. For a super high net worth individual who might say, gosh, I need 100 million to even move the needle on what I own.
Sure.
It's hard to deploy 100 million in anything right away.
Yes, it is.
And so given the thinness in the markets, that strategy might be, I need it in 5 parts of the country. I need some Pacific Northwest. I need some row crop agriculture. I need some Southern California exposure. I want to actually make a water play. And increasingly, we're also seeing people who are trying to, this is kind of the punchline of the answer, people who are trying to get in the way of what's coming next. And so green energy transformation.
Today there was a big conversation about solar, right?
Solar and wind.
Was the conversation today.
Absolutely. And the investment that we've at least begun identifying the possibility of going to net zero or prior to that, just generally greening of the energy complex, or you've heard of sustainable aviation fuel by now, or renewable diesel, and things that are, instead of using the green thing you grew on the land to make food or to feed it to an animal first, you're using it to make fuel or some other energy use in the long term. So you're feeding it to your SUV instead of feeding it to your pig or to your, directly consuming it as a ground up flour or something.
Okay.
So I think understanding that the nature of the use of agricultural outputs is changing dramatically. The world demand for higher calorie, higher quality diets is not something we can turn back. That is a directional effect that's pretty easy to predict at this point. We're going to have more people, and I'm going to predict they're going to eat food.
Right.
And so getting in the space where that's going to increase the demand for those portions of production, I think, is another thesis. So.
That's fantastic. And I want to end again with a deeper dive, right? Not a cursory answer. But, through teaching in the classes you've taught, there's an awful lot of CFP professionals today who took a class with you, right? If you're talking to our audience and you're talking to wealth managers, you're talking to, some insurance agents, you're talking to registered reps and that financial service crew, what advice do you give them? They say, you know what, I'd like to start my clients investing with alts. It's a little overwhelming. I don't really want to go get a CFA, right? Where do I start this journey?
So I think I'll turn this into partially just because we know each other. I'll start with a compliment to you and the program you're building at the U of I. It's just an absolutely fantastic program. The numbers of students you're training and putting out and getting prepared to become professionals in the financial planning space is just astounding, just absolutely incredible. The attention to agriculture and the fact that it is a unique asset class, and there's so much untapped wealth, and historically I think farm families were probably underserved a bit in terms of financial planning.
So. Absolutely. I believe that wholeheartedly. It's been a lot of our mission here.
To some degree, it's rectifying that situation is the first piece of advice. If you're going to have ready clientele, the super wealthy ones who haven't been pursued before might not be the worst place to start, and that happens to fit agriculture right now. But the next thing is to find a place that you can develop a relationship with. again, not pulling out anybody in particular, but if you think about the folks who are represented here today, a lot of them are in exactly that business of saying, we have money, and if you need to put it in a DST, or if you have capital gains and you need to put it in an OZ, there are agricultural versions of those in the room today, ready to be tapped on the shoulder.
So I think my takeaway, I will say it, I think we spend a lot of time in financial services going to conferences, right? And you're talking to somebody that went to way too many last year, right? I'll be the first to say it. But I think as we get into conferences and conference season, let's think a lot about where we want to go and where we want to be, and not necessarily the comfortable of where we've gone before, right?
I like that.
And I think that, to that end, I'm not trying to throw shade on anything, but I do think it's important to say, all right, I want to learn more about alts. I want to use alts with my clients. Well, let's look at places where you can learn that and actually be able to work on those levels.
Absolutely. And if you look at the last 5 years, just to sort of double back on something, play on words of one of the folks who were here today.
What you did there.
The commercial real estate space has, of course, just been bludgeoned post-COVID.
Sure.
And agriculture was not.
Right.
And prior to that, in 2008, when the housing industry was bludgeoned, agriculture came through relatively unscathed. And there are reasons for that. There's a very strong safety net behind agriculture in the form of government support programs and so on. But as an alt investment that complements the other real estate investments, I think it also needs to be considered by even the traditionalist crowd, and not having exposure to just strip malls or to office buildings only. Again, you have to go to a lot of conferences to cover all that waterfront, because
right.
the office tower, JLLs and so on are not at this conference. They're at a different conference
The
today.
office tower conference,
But I think,
in an office tower.
But I think that they are all in this alt space. And
right.
I think agriculture is emerging as a really important one.
I think it is. And I think that to some extent, there's a lot culturally that goes into agriculture and philosophy on lending and credit that maybe has not caused the same crises. Just from a philosophical, cultural standpoint, I do think there's a debt aversion that other sectors of alts have not had, that sort of cultural American debt aversion. And I think that does play in here some. Oh,
without a doubt. There's reasons that make it rational, but as we visited just earlier today, agriculture is unique in that there's only about 13.5% debt underneath the long-term assets in the sector. And that's absurdly low if you were to compare it to, say, companies in the S&P or commercial real estate, or even people with their first mortgage. And so there is something unique about that. And it does provide a kind of protection that's somewhat unique relative to the other alt space.
I think it is. And that's definitely something I'm going to be thinking about over the next year or two. But Bruce, thank you so much. I'm sure we will have you on the podcast many more times. And I really appreciate talking to you today.